Hello students, this is the second video on income from house property. In this video, we will be covering deductions under section 23(1) and 24(a) and (b), municipal taxes and interest on loan taken to purchase, construct and repair or renovate the house property. This video is very important for solving the long problems. Already I made first video. In that video, I have covered a determination of annual value and basic concepts. I will be sharing the link of that video in the I button as well as in the description box. Please do watch that video to understand better the concept and chapter of income from house property. So let's start this video. Deductions of municipal taxes, section 23 subsection 1. Any tax levied by local authority or municipality or municipal authority on house property is allowed as deduction from income from house property. While calculating the annual value, we can deduct this tax levied by the municipal authority. Local authority may be known as with any name: municipal corporation, town area committee, cantonment board. These taxes generally charge as a percentage on the municipal value of the house property. So these taxes are allowed as deduction by the assessee under section 23 subsection 1. Which taxes are allowed as deduction? These municipal taxes are allowed as deduction from gross annual value (GAV) only if it is paid by the owner of the house property. If it is paid by the tenant, these expenses are not allowed. Owner must pay these expenses. Only paid by the owner is allowed. Please bear in mind, this is very significant. Only paid amount is allowed as deduction, not the outstanding amount. Suppose the current year municipal taxes, let's say 10,000, owner had paid only 8,000. Then 8,000 only is allowed as deduction, not 10,000. Last year's municipal taxes, if paid in the current year, even it is allowed as deduction. Last year's or past year's municipal taxes, if paid in the current year, even allowed as deduction. If property is situated in foreign country, foreign taxes are allowed as deduction. Now, if you see this question, with this question, we will try to understand the municipal taxes concept. Mr. D owns a house at Vijayanagar and submit the following particulars. Rent received 175. Standard rent 160, municipal valuation 170, fair rental value is 1,72,000. Municipal taxes 12% of MRV plus 2% of municipal taxes as sanitation charges. So we are asked to calculate net annual value. So in order to calculate net annual value, first we need to calculate what? GAV or ARV, annual rental value or gross annual value. MRV, FRV, whichever is higher. So MRV is 170, FRV is 172, whichever is higher, 172, is compared with standard rent. What is our standard rent? 1,60,000. Whichever is lower is ERV. ERV stands for expected rental value. Right? All these concepts I have explained in the first video. Please do watch that video to understand better. So whichever is lower is ERV, that is 1,60,000. 1,60,000 ERV must be compared with actual rent received, that is 1,75,000. Whichever is higher is called as GAV or ARV. So our gross annual value is 1,75,000. So once we calculate gross annual value, we will take 1,75,000 minus municipal taxes. Which municipal taxes? Paid by the owner only. Right? Not outstanding amount. Paid amount must be taken, and past year municipal taxes, if it is paid in the current year, even allowed as deduction. These things you bear in mind. So municipal taxes at the rate of 12% of MRV. MRV is 1,70,000 into 12%, 20,400. Plus sanitation charges are 2% of municipal taxes, that is 20,400 into 2%, 408. Collectively 20,808 are the municipal taxes. If you deduct these municipal taxes from the gross annual value, you will be getting 1,54,192 as your net annual value. Right? I hope I made you understand this crux. So let's start next concept. Deductions under section 24. In the sense, we have already covered deductions under section 23, that is municipal taxes. Now we will be talking about the 24. In 24 there are two taxes. Sorry, there are two deductions, not taxes. There are two deductions. Deductions under section 24A, 24B. 24A talks about standard deduction at the rate of 30% of net annual value on let out or deemed to be let out house property. It should be either let out or deemed to be let out, not self-occupied. In the sense, on self-occupied house property, you will not get standard deduction at the rate of 30%. Whereas under section 24B, the interest on loan taken to purchase, construct, repair, renovate the house property, both let out, deemed to be let out, as well as self-occupied. So all the houses can avail the deduction of under section 24B, that is interest on loan. Clear? So these are the two deductions will be given under section 24A and B. Now when you come to the 24A, 24B, 24A is quite simple. That is 30% of NAV, net annual value, if it is let out or deemed to be let out, not on self-occupied. Whereas 24B, interest on loan taken to purchase, construct, repair or renovate the house property. Right? So in this case, whatever loan that we have taken to purchase, construct, renovate or repair the house property, on that whatever interest is paid by the assessee, that is allowed as deduction. With that, about that we will be discussing under 24B. A. Situation A. Let out or deemed to be let out house property. If the loan is taken to construct, repair, renovate and purchase the house, and that house is let out or deemed to be let out, in that case, while calculating the let out or deemed to be let out house property income, there is no maximum limit of interest on loan taken to purchase, construct, repair, renovate of the house property. There is no maximum limit. Whatever interest paid by the assessee during the previous year, that is clearly allowed as deduction, provided that house property must be let out or deemed to be let out, not self-occupied. Please bear in mind this situation. Then in case of self-occupied house, earlier case we discussed let out, deemed to be let out. Now B case is self-occupied house property. Here we have two provisions, right? So self-occupied house, if loan is taken before 1,499 and one is after 1,499. Clear? And bear in mind, for self-occupied house, NAV should be taken as nil, 0. Net annual value will be 0. So if the interest on loan taken before 1,499, in that case, interest on loan is allowed up to maximum of 30,000 on purchase, construct, repair, renovate of the house property. 1,499. Maximum allowed deduction is 30,000 rupees. If the loan is taken after 1,499, there are two situations. One is if it is purchase or construct, right? Purchase or construction of self-occupied house. In that case, interest on loan is allowed up to maximum of 2 lakh on purchase or construction or acquisition of the house property. So maximum interest is 2 lakh if the loan is taken after 1,499, provided that loan must be used to either purchase or construct the house, provided the following conditions are fulfilled. That conditions are: the construction or acquisition of house property must be completed within 5 years from the date of financial year in which the loan or capital was borrowed. The borrower obtain a certificate from the lender specifying the amount of interest payable, and the certificate must be specify the purpose of the loan. Anyway, this certificate will be taken. So if these conditions are satisfied, maximum 2 lakh rupees is allowed as deduction after 1,499. Right? If the house property construction is not completed within 5 years, then maximum amount will be reduced to 30,000. Bear in mind, will not be given 2 lakh, only 30,000 if the conditions are not satisfied. Right? Suppose if the loan is taken for the repair and renovate the house property, in that case the maximum limit is 30,000. right? So in this way we have to calculate the interest on loan which is allowed as deduction in various situations. Treatment of pre-construction or acquisition period interest. And prior to this, bear in mind, interest, if it is paid or outstanding, both are allowed as deduction. In case of municipal taxes, if it is paid, then only allowed as deduction. But in case of interest, if it is paid or outstanding, both are allowed as deduction. Now the next concept is pre-construction period or acquisition. Pre-construction period or acquisition period interest. Prior to the construction, prior to the starting of the house property which is generating income, if you pay any interest on that house property, generally what will happen when we take a loan to construct the house, the construction process minimum take 3 to 4 years, right, if it is a big house. So in that case, whatever interest that we pay during that period, how it will be allowed as deduction, that we will be discussing in this presentation. What is pre-construction period and acquisition period interest? It means that period starting from the date of borrowing and lending on ending on date of borrowing and ending on March 31st immediately, preceding to the year of completion of the construction of the house property. For example, you see the example, Mr. X taken a loan on 1/4/2018 for construction of a house and the construction was completed on 1/8/2021. So what will happen? Loan taken 1/4/2018 and construction was completed 1/8/2021. In the above case, pre-construction period shall be starting from 1/4/2008, which the date which we have taken the loan, and ending on 31st March 2021. 31st March 2000 in the sense before the completion. So what about the 1st April to 1st August, right? The house was incomplete, no? So that interest will be treated as current year interest. That will be allowed as current year interest. But before 31st March of that particular year, whatever interest is paid, that is called as pre-construction period. What is the tax treatment? Pre-construction or acquisition period interest shall be allowed as deduction in 5 equal installments starting from the previous year in which the house property acquired or construction is completed, and for the next 4 previous year. In the sense, whatever amount that you have paid from 1/4/2018 to 31st March 2021, that will be made summation and divided into 5 installments, and down the line 5 years, that same amount, 5 equal installments, will be deducted as pre-construction period interest. This is the concept. So just have a look at this precise table, right, flow chart. You can easily understand whatever I have explained. The same thing is available. Interest on loan, house property. First one is let out, deemed to be let out, no limit. Right? If it is let out or deemed to be let out, no limit. You can deduct whatever amount of interest you paid. Right? Next, self-occupied house. Self-occupied house, there are 2 situations. If loan is taken before 1/4/99 or after 1/4/99. Right? If the loan is taken before 1/4/99, straight away 30,000 is the maximum amount as deduction. If loan is taken after 1/4/99, again there are 2 situations. If it is taken for construction or renovation or repairs. If it is construction, maximum is 2 lakhs. The conditions are the house property construction should be completed within 5 years and certificate must be taken from the lender, the bank or the loan provider. If the loan is taken for the repairs, then maximum limit is 30,000. Right? So these are the basic conditions for interest on loan taken to construct, repair and renovate the house property. I have taken one question to make you understand better. Compute the income from house property from the information given below. Municipal rental value we have given 18,000, rent received during the year 24,000, municipal taxes 50% paid. So we have to take only 50% because 50% paid by the tenant, in the sense rest of the 50% paid by the owner. So whatever municipal taxes paid by the owner only allowed as deduction. In this case 1800, in the sense 50% is 900 is allowed as deduction. Then expenses incurred on repairs by owner, by tenant, we don't consider this. Collection charges is not allowed as deduction. Date of completion of the house property 1/6/1998, right? So before 1/4/1999. So how to calculate? So first we need to calculate GAV or ARV, annual rental value. MRV, FRV, whichever is higher. Standard rent is not given. The higher value itself is ERV, that is 18,000. Rent received is 24,000. So of these two values, whichever is higher, that is 24,000 is GAV. Once you calculate GAV, then you can calculate income from house property. Gross annual value we have given 24,000 minus municipal taxes. As already I told you that 50% we have to take since it is paid by owner, that is 900. So once you deduct this, 23,100 is the net annual value. From this, deductions under section 24A, standard deduction at the rate of 30% of NAV, that is 23,100 into 30%, that is 6,930. Then interest on loan taken to construct, repair and purchase of the house property, we have not given any interest amount, therefore we have taken 0. So total deduction comes to under 24, that is 6,930. So once you deduct that, income from house property is 16,170. In this way we have to calculate, right? So one more question is available here for better understanding. This is with regards to pre-construction period interest. If you see, there are two houses, one is self-occupied, another one is let-out house. In case of self-occupied house, MRV, FRV, municipal taxes, ground rent and interest on loan. Whereas in case of let-out house property, we have given municipal value, actual rent received, municipal taxes, interest on loan taken for the previous years, that is 2022-23, 10,000, 21-22, 20-21, 19-20, so on, we have given till 2016-17 the values. Then ground rent, fire insurance premium, right? Income from other sources 50,000. What we are asked to calculate? Compute the total income of Mr. P. Agarwal for the assessment year 2023-24. The house was completed on 1/9/2017. In the sense, before 31st March 2017 is the pre-construction period interest. Clear? So let's start. Right. So computation of annual rental value. Then this is for let out house property. For self-occupied house, the annual rental value is nil, right? Because it is self-occupied. GAV is nil. NAV is also nil. So for let out house property, MRV is 24,000. FRV is not given. Whichever is higher, 24,000 itself is higher value. Then standard rent not given. Then higher value itself is ERV. Compared with actual rent received, that is 30,000. 30,000 is the greatest amount, therefore GAV is 30,000. Now when you come to the computation of income from house property, we have two houses. One is self-occupied, another one is let out. In case of self-occupied house, we have taken GAV nil, NAV nil, net annual value. But gross annual value of the let out house property is 30,000 less municipal taxes. Municipal taxes we have to take only for the let out house property. Let out house property municipal taxes are 2,400 that we have deducted. The net annual value of the self-occupied house is 0, that is nil, and let out house property is 27,600. From this we have to deduct deductions under section 24. Standard deduction at the rate of 30% of NAV, that is 23,100 into 30%. Clear? Then interest on loan taken. Interest on loan taken to construct the house is, how much interest we have paid? Current year interest is 30,000, that is 23 interest is 10,000, and self-occupied house is also 10,000 and let out house property is also 10,000. But what about pre-construction period interest, sir? Because the information is not available, 2016 and 17 is the pre-construction period interest, right? So because the house property was completed in 17-18, 1/9/2017, and 17-19 the house was completed. What is the pre-construction period interest? That is 16 and 17. How much? 2,000. If I am not wrong, 2,400 it is given. Then this will be divided into 5 equal installment. In the sense, by the year we reach 2022-23, already it is been deducted from 2017-18, 18-19, 19-20, 20-21, 21-22. So there is no pre-construction period interest in this case. Clear? So I hope I have given you the clear picture how to calculate this. Then we have also provided the income from other sources. So we have to calculate GTI. GTI stands for gross total income. Income from house property is how much? Right. So sorry, here the self-occupied house income is minus 10,000. That is loss from house property from the self-occupied house. But the income from let out house property is 9,320. So net income from house property, income from house property is 9,320 minus loss is 10,000. So net loss is 680 rupees from income from house property. Other sources income is 50,000. So the income from house property loss can be adjusted from the other sources income. Therefore total income, that is gross total income, is 49,320. I hope I have given you clear understanding about this concept, right? So thanks for watching the video. Wish you all the best. Thanks for watching the video. Do subscribe my channel Mentor the Trusted Guide and motivate me to make more qualitative and informative videos. Thank you very much.